everybody, Chris here from Project Option, and in today's options trading strategies video, we're going to talk about the long straddle. Now the long straddle strategy profits when the stock price makes a significant movement in either direction or when implied volatility increases. So in this video we're going to talk about the general characteristics of the long straddle, and then we're going to talk about the expiration risk profile graph, and then we're going to finish off with a couple real long straddle trade examples so that you can see how the position performs in various scenarios. So let's dive right in. Alright, so buying straddles, or sometimes referred to as a long straddle, is an option strategy constructed by buying a call and put option at the same strike price and in the same expiration cycle. Now most of the time the at the money strike price is used. Now the maximum profit potential of a long straddle is theoretically unlimited because you do own a call option and there's no limit to how high a stock price can rise. Now the maximum loss potential for a long straddle is the debit paid times 100. So if you pay $10 in premium for a long straddle, then your maximum loss potential is $10 times 100 or $1,000 per long straddle. Now the maximum loss is a very rare scenario because that only happens when the stock price is right at your long straddle strike price. So most of the time a long straddle will expire with some intrinsic value, but there still could be a substantial loss there if the stock price does not move away from that strike price. So the expiration break-even prices are going to be the strike price plus the debit paid and the strike price minus the debit paid. So to make money on a long straddle at expiration, the stock price has to have moved more than the debit you paid away from the straddle strike price. Now it doesn't matter if that movement is up or down. Now since you need a large stock price movement to profit with a long straddle, the estimated probability of profit is less than 50%. Now the resulting position after expiration depends on if the long call or the long put is in the money. So if the long call is in the money at expiration, then a long straddle will expire to plus 100 shares of stock per call option that you have. Now if the long put is in the money at expiration, then the position will expire to negative 100 shares of stock per long put. So that's essentially a short stock position of 100 shares per put that you own. Now, since a long straddle does not include any short option components, there is no early assignment risk. Alright, now let's apply those general characteristics to a hypothetical long straddle position. So at the time of these option prices, let's say the stock price is trading at $250 and we believe the stock price is going to make a significant move in either direction. So to construct a long straddle position, we're going to buy the 250 put for $15.10 and we're going to buy the 250 call for $15.20. Now that's going to bring our net debit to $30.30. So let's go ahead and take a look at the expiration risk profile graph for this position. Okay, so as we can see here, we bought the 250 straddle for $30.30, and as we can see based on this graph that our maximum loss potential is $3,030. Now that comes from the $30.30 debit we paid times 100. So if the stock price is right at 250 at expiration, both the long put and long call that we purchased will expire worthless and we'll lose the entire debit that we paid. Now our break-even prices in this example are going to be the strike price of 250 plus the debit paid and the strike price of 250 minus the debit paid. So our lower break-even price is $219.70 and our upper break-even price is $280.30. And lastly, we can see that there's significant profit potential when the stock price increases or decreases significantly. So when you buy a straddle, you're betting that the stock price is going to make an outsized move, and if it does not, then you will lose money from time decay as time passes because those long options that you own will be losing their extrinsic value. Alright, so now that you've seen the expiration risk profile graph and the general characteristics of the long straddle strategy, let's go ahead and take a look at the Greek exposure so that you can understand how the position is expected to perform before it expires. So in general, the delta of a long straddle will begin at 0 because most of the time people will buy an at the money straddle. And that means the call delta and the put delta will be offsetting each other and you'll have virtually no directional exposure. However, you can structure a long straddle in a directional manner by purchasing an out of the money strike price. Now that's not very common because generally a long straddle is entered with a market neutral bias and you want the stock price to move significantly away from the strike price that you buy. Now, in terms of gamma, a long straddle has positive gamma, and that's really what drives the profits of the strategy. So, positive gamma means that when the stock price rises, a long straddle becomes more directionally long, and that means you want the stock price to continue upwards because now that you have a positive delta, you'll start to make money if the stock price continues to rise. Now, when the stock price falls, a long straddle position becomes more short, and that's because the position delta gets more and more negative. Now, that means you want the downside price action to continue because with your negative delta, you'll make money if the stock price continues to decrease. Now, in regards to theta, a long straddle's theta is negative, and that means that the extrinsic value of options decays over time, and that leads to decreasing option prices, which is obviously not what you want when you buy a straddle. So if the stock price sits right at your long strike as time passes, you're going to lose money from time decay because the extrinsic value of the options that you own is decreasing. Now lastly, vega is positive for a long straddle position because you'll make money if implied volatility increases. Now that's because an increase in implied volatility indicates that option prices are increasing, which is obviously what you want as an option owner. Now on the other hand, decreases in implied volatility indicate that option prices are falling, which means that you'll be losing money from owning that straddle. So when you put all these Greeks together, we learn that a long straddle position profits in two ways. The first being a significant stock price movement in either direction, and the second being an increase in implied volatility. Now, a long straddle can also lose money in two ways, and that's primarily from the passage of time from that negative theta, but you can also lose money if implied volatility decreases. So now let's go ahead and get into some example trades to show you how the long straddle strategy performs in various scenarios. So the first example we're going to look at is where a long straddle incurs a big loss. Now that happens when the stock price is near the strike price that you purchase at expiration. So here's the setup. The initial stock price is $210.72. Initial implied volatility is 15%, and we're going to buy the 211 put and the 211 call that expire in 77 days. Now, for the straddle, we're going to pay a net debit of $9.78, and that's going to bring our upper break-even price to $220.78 and our lower break-even price to $201.22. So those break-even prices come from the straddle strike price plus the debit and the straddle strike price minus the debit. Now our maximum profit potential is theoretically unlimited, and the maximum loss potential is the debit paid, which is $9.78, times 100, which is $978 per straddle. So let's go ahead and see what happens to this position over time. Alright, so on the top part of this graph, we're looking at the straddle strike price of $211, and we can see the upper break-even price and the lower break-even price, and on top of all of that, we see the changes in the stock price. So in the bottom part of the graph, we're looking at the entry price of our long straddle, and then we're looking at the changes in that straddle price, as well as any corresponding profits or losses. So when the straddle price increases from our point of entry, we have profits, and when the straddle price decreases from our point of entry, we have losses. So in this example, we can see that the stock price remains right around our strike price of $211 over the entire 77-day period. Now on the bottom part of the graph, we can see that the straddle's price steadily loses value. Now that's from that negative theta that we talked about. So as the stock price remains around $211 as time passes, the 211 call and the 211 put are losing extrinsic value, and that leads to a cheaper and cheaper straddle price, which leads to losses for us. So unfortunately, in this case, the straddle incurred a large loss, and at expiration it was worth right around $1.25 or $1.50, which means we pretty much lost 85 to 90% of what we paid for this straddle. Now it is important to note that at expiration, that long 211 call is in the money. Now that means if this position was held through expiration, that long call would expire to plus 100 shares of stock. So you would buy 100 shares of stock at that 211 strike price. So if you did not want a stock position after expiration, you'd have to close that long call before it expires. Alright, so let's look at example trade number 2, a break-even long straddle. So here is the setup. The initial stock price is $210.56, and we're going to buy the 211 put and 211 call that expire in 60 days. Now the net debit we're going to pay for this trade is $8.34, and that's going to bring our upper break-even price to $219.34 and our lower break-even price to $202.66. Now our maximum profit potential is unlimited, and our maximum loss potential is the amount we paid of $8.34 times 100, and that comes out to $834 per long straddle. So let's go ahead and take a look at what happens to this position over time. Alright, so in the top part of the graph, we're looking at the changes in the stock price relative to our straddle's strike price and break-even points. And in the bottom part of the graph, we're looking at the price changes of that 211 straddle. So as we can see, right after we bought that 211 straddle, the stock price fell down to around $185, and at the same time, that straddle price rose from $8.34 all the way up to $25. So the straddle price tripled. Now, in this particular case, the stock price did recover and rallied all the way back to our lower break-even price of $202.66 at the time of expiration. So if the trader who bought this straddle did not lock in their profits early on this trade, then they would have just broke even at expiration, which is not a bad outcome at all. So since that 211 long put was in the money at expiration, keep in mind that this position would expire to negative 100 shares of stock per long put. So if you didn't want a short stock position after expiration, you'd have to go ahead and sell that long put before it expires. So this example is actually a good demonstration of how positive gamma works for a long straddle position. So at the time of buying the straddle, the position delta was right around 0, which means we essentially had no exposure to small changes in the stock price. However, as the stock price fell towards 185, that long puts delta starts to grow more negative, and the long calls delta starts to decrease towards 0. So the net effect of that is that the position delta of the long straddle starts to grow more towards negative 100. Now, a delta of negative 80 means that if the stock price decreases by $1 more, we're expected to profit by $80. And if the stock price increases by $1, we're expected to lose $80. So as we can see here, if the stock price decreases away from our long straddle strike price, our position becomes more short because our position delta is negative. Now that means that we want the stock to continue to decrease because that's going to lead to more and more profits for a long straddle position. Now the opposite is true on the upside. If the stock price starts to increase, a long straddle's position delta will start to grow towards 100 for each long straddle, and that's because the long call will be more and more in the money, and the position delta of that long call will approach plus 100, while the long puts delta will approach 0. So that means the long straddle's position delta will grow more towards plus 100, and that just means that we want the stock price to continue rising because we'll benefit more and more from a continuation of that move. Alright, so in this final example, we're going to look at a collapsing stock price after a long straddle position is initiated. And obviously that should be a good thing for a long straddle position because when you buy a straddle, you need a large stock price movement in either direction. So here's the setup. The initial stock price is 126.20, and for our long straddle, we're going to buy the 126 put and 126 call, expiring in 78 days. Now we're going to pay a net debit of $10.25, and that's going to bring our upper break-even price to $136.25 and our lower break-even price to $115.75. Now, as always, our maximum profit potential is unlimited, and the most we can lose is the debit paid times 100, which is $1,025. So let's go ahead and see what happens to this position as the stock price moves through time. Alright, so in the top part of the graph, we're looking at the changes in the stock price relative to our straddle's strike price and break-even points. And in the bottom part of the graph, we're looking at the changes in the straddle price from our initial point of entry. Now, as we can see here, in the top part of the graph, the stock price remains right around our strike price of 126 for the first 45 days or so. And in the bottom part of the graph, we can see that the long straddle is actually losing value over that time period. Now, later on in the period, before the straddle expires, we can see that the stock price falls from 126 all the way down to $85 at the lowest point. And while that move happens, the straddle's price increases from $10 all the way up to around $37. So as we can see here, the straddle price almost quadrupled over that period because the stock price made a significant movement that was not expected. So this is just a great example of how when you buy a straddle, you need the stock price to move in a very, very significant way, either up or down, and that will lead to profits for a long straddle holder. Now in this case, the profits came from not only that directional movement to the downside, but also from an implied volatility increase. So when a stock decreases in value rapidly, its option prices tend to expand quickly as well. So both of those factors led to a profitable long straddle position in this particular case. Alright, now let's quickly summarize the main concepts from this video. So first and foremost, buying straddles is a directionally neutral strategy that consists of buying a put and call option with the same strike price and expiration cycle. Now most of the time, at-the-money options are used. Now the main profit drivers when buying straddles are increases in implied volatility because a long straddle has positive vega, or large stock price movements in either direction because a long straddle has positive gamma. Now since the stock price or implied volatility has to change significantly for a long straddle to be profitable, buying straddles is a low probability trade. Now to close a long straddle before expiration, the long call and put can be sold at their current market prices to lock in profits or losses. And lastly, if the stock price is below the straddle strike at expiration, the long put will expire to negative 100 shares of stock, and if the stock price is above the straddle strike price at expiration, the long call will expire to plus 100 shares of stock. So if you don't want a stock position at expiration, you're going to have to close your long straddle before it expires. Thank you for watching this video, everybody. If you enjoyed this video, please go ahead and subscribe to our YouTube channel by clicking on that circle on the left-hand side. And if you want to check out some more options trading strategies, go ahead and click on the playlist on the right side.